Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning and welcome to Money Talk for Thursday, the 26th of October 2023. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. This is Peter Lewis with today's business and finance headlines on one of Hong Kong's most listened to financial podcasts. Hong Kong Chief Executive John Lee delivered his second policy address Wednesday morning. The CE stressed his speech was aimed at fostering hope, unity and vitality to drive the city's prosperity. Among the highlights were big cuts in property and stock trading taxes and a $20,000 cash handout for families that have a newborn baby. In the USA, Representative Mike Johnson of Louisiana, a loyal ally of Donald Trump, has been elected as the 56th Speaker of the US House after 3 weeks of turmoil. Mr. Johnson won a House ballot with 220 votes compared to the 209 of Democratic candidate Hakeem Jeffries. His election signals a sharp turn to the right for Republicans in the lower chamber. Mr. Johnson voted against certifying Joe Biden's 2020 election victory and has opposed more Ukraine aid. Canada's central bank held its key interest rate at a 22-year high of 5% on Wednesday as expected, saying prior rate increases had slowed down price growth and dampened economic activity. This was the third consecutive meeting at which officials held the policy rate unchanged. The yield on the US 10-year Treasury note rose for a second day to above 4.9% on Wednesday, approaching once again the 16-year high of 5.02% touched earlier in the week. It ended the session 12 basis points higher at 4.95%. And billionaire hedge fund manager Bill Ackman made a profit of about $200 million from his high-profile bet against US 30-year Treasury bonds. On today's programme, I'm joined by Andrew Freris, the CEO of Ecognosis Advisory, and Nick Marro, lead for global trade at the Economist Intelligence Unit. Discussing the latest developments in the oil markets is Vandana, founder of Vanda Insights. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com, or contact me on Facebook. Peter Lewis Money Talk is the page, or on X at MoneyTalkR3. On Wall Street on Wednesday, US stocks closed sharply lower as investors weighed the latest batch of corporate results. The S&P 500 and Nasdaq hit levels not seen since May as Treasury yields rose for a second day, pressurising rate-sensitive tech shares. The S&P 500 fell 1.4% to 4,187, ending the day below the 4,200 level that was being widely watched by chart analysts. The Dow fell 105 points, or 1/3% to 33,036. The Nasdaq Composite lost 2.4% to finish the session at 12,821 for its worst day since February the 21st. Today's decline pulled the tech-heavy index down more than 10% from its recent high, putting it in correction territory. Alphabet sank 9.6%, its worst loss in about a year after its cloud unit reported Tuesday a smaller than expected revenue. Alphabet lost more than $166 billion in market cap yesterday, marking its largest one-day loss in value ever. Shares of Microsoft rose 3.1% after the company's revenue, earnings and guidance topped estimates. Gold, considered a haven asset, rose 0.4% to $1,970 an ounce, $978 an ounce, sorry. The precious metal has gained 8% since Hamas's October the 7th attack on Israel. Oil prices were firmer on Wednesday despite bearish inventory data, as traders worried about a Gaza ground invasion. Brent crude oil settled 2.3% higher at $90.13 a barrel. The US dollar index was firmer on Wednesday and closed up 1/3% at the day's high of 106.5. The yen dropped to its weakest level this year against the dollar. The yen depreciated 1/3% to 150.32 per dollar. That's a level not seen since October 2022. The Chinese yuan was almost unchanged at 7.31.5 in onshore markets. Chinese stocks rallied after Beijing took stronger action to support the world's second largest economy, raising the fiscal deficit limit. The Shanghai Composite Index rose 0.4% to 2,974. In Hong Kong, the Hang Seng Index climbed 94 points, or 0.6%, to 17,085, having been up as much as 2.8% earlier in the session. The Hang Seng Properties Index, which tracks the city's top developers, rose as much as 3.7% ahead of John Lee's policy address, but lost ground in afternoon trading to be up just 0.5%, and that gauge has fallen almost a third this year. You can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
We've got a lot to get through this morning, so let's go straight to our guests. We have with us Andrew Freris, the CEO of Ecognosis Advisory, our regular Thursday commentator. Morning, Andrew.
Good morning.
And also with us Nick Marro, who is lead for global trade at the Economist Intelligence Unit. Nice to talk with you once again, Nick.
Good morning, everybody.
Let's start with the policy address. Hong Kong Chief Executive John Lee delivered his second address yesterday morning. The CE stressed his speech was aimed at fostering hope, unity and vitality to drive the city's prosperity. Over the past year, he said his government has led Hong Kong out of the pandemic, with society returning to full normalcy. And Mr. Lee said the economy is recovering, people's incomes are improving. He said real GDP in the first half of the year saw a 2.2% increase year on year. Although I should add the territory's economy did grow a rather lacklustre 1.5% year on year in the second quarter. He said the latest unemployment rate dropped to 2.8%, reflecting nearly full employment, and he said the economy is set to reverse last year's negative results and resume growth this year. And in his address, Mr. Lee unveiled broad-ranging plans to bolster Hong Kong's shipping, aviation, technology, arbitration and exhibition sectors in the government's attempts to boost the SAR's economic attractiveness. Andrew and Nick, before we get on to specific measures that he announced, can I ask you for just your broad impression overall of the policy address, and also what he's saying he hopes to do, which is to boost Hong Kong's economic attractiveness? Maybe, Andrew, you want to kick off?
Simply looking at the hierarchization, I'll try that again slowly, the hierarchy by which the topics were introduced. It is very, very clear that this is a political speech. The first topic was the way in which one country, two systems is going to firmed up, maintained, and pushed forward. And the national security law is going to be passed. That was item number one. And item number two was the patriotic education of pupils, of students, of civil servants, and of citizens in general. So in other words, the two first things he had to say was about firming up the links of Hong Kong with mainland China, which is perfectly okay. I mean, this is not a criticism, this is simply a statement. But it set, if you want, the background against which everything else proceeded.
I couldn't help thinking when I heard the beginning of that, and as you say, his top priority, national security, more patriotic education, I couldn't help thinking that's going to add about another 100,000 people in the exodus out of Hong Kong.
Well, I'm not saying that for one moment as a criticism, never mind what I might or might not be thinking. This is simply a fact. I'm looking at that. And I think he should be congratulated in a sense of flagging his flag on, nailing his flag on the mast. He says, first and foremost, politics is most important. That Hong Kong will more than ever be a part of China, as if it is not already, but it will continue furthering the process of becoming an integral part of China. Now, the security law is old news because this has been going on well before even the political let's say, uncertainties of year 1819. So this is hardly a big surprise. Okay, but it is something that, as you say, it is touchy because the world had, in general, a negative reaction when China introduced part of its own security law to Hong Kong. Now we're going to have our own. So that's the reality of the situation, and then everything else follows.
Nick, what are your overall impressions of the policy address?
Yeah, similar to what Andrew just said. So I guess I'll back up a little bit and talk, I guess, with the broader picture of economic expectations. Our forecast for Hong Kong was to expect, real GDP growth of around 3%, just shy of 3% this year. That's assuming that growth accelerates in the second half of this year after somewhat lackluster performance in the first half. But given the low base from, the second half period in 2022, the fact that Hong Kong is reopened, in theory, this acceleration should continue. On that same note, when we talk to companies and investors, there still seems to be a lot of hope for Hong Kong in its post-opening phase. This idea that its links with mainland China, particularly from the financial and information flow side, are unrivaled. That's one of the reasons that's going to keep Hong Kong relevant vis-a-vis, say, Singapore. But all that optimism has to be couched against the backdrop of the politics, just like Andrew mentioned. And I think this emphasis on national security, it's really hard to overemphasize the fact that Hong Kong's reputation internationally has taken a huge hit. When we talk to people overseas, one of the biggest challenges is the perception of Hong Kong. And when we talk to companies who are based in the city, one of their biggest challenges is encouraging talents to come to the city from abroad because of those same exact perceptions around the politics, around national security. I think this kind of re-emphasis on national security, this discussion of, introducing Article 23, and moving forward with this continued tightening, kind of this likely tightening the civil and political arena, that's going to work against these perceptions. And for all of the optimism that people are trying to, kindle and hold on to and hope that carries them through into 2024 and beyond, that's going to be kind of overshadowed by these political dynamics. And so for all of the rhetoric the government's coming out with around, attracting talent, re-injecting vitality into the city, showing the world that Hong Kong is open for business again, it all kind of comes back into questioning mode when we're looking at, the clouds of national security and the political discussions. So I would say that in terms of balancing the optics here, that's the thing that is going to weigh on a lot of investors' minds and the minds of people who are thinking about, using Hong Kong as a base to go back into mainland China.
You've expressed it very well there. I mean, on the one hand, he wants to attract companies to come and make their headquarters in Hong Kong. He was talking about making it easier for people to join these talent schemes. He wants people to come, make Hong Kong a lot more attractive. But then the starting point is the very thing that's frightening people off.
Yeah, that's exactly right. And I mean, when we think about the new talent scheme, I think there will be, a likely boost in people who are looking to take advantage of that. But a lot of that's going to come from the mainland rather than from, non-mainland markets. And one thing that we've been hearing from, colleagues or even just anecdotally in the last couple of quarters is that, if you're a mainland, professional, you might actually be looking at opportunities in Shanghai or Beijing more so than you're looking at Hong Kong. And if you're looking at, leaving the mainland, you're considering places like London or New York or Singapore. Hong Kong is maybe not as high on the priority as it used to be. And I think a lot of that reflects the political dynamics and the changes in the political landscape that have happened in the last couple of years. And so really it has to be this uphill battle of tackling the perceptions that Hong Kong faces, which I think the government, is aware of, but to date doesn't really seem like it has a good sense of how to actually address this and how to actually alleviate people's concerns. And I think that's full on display, this inability to do so. That's full on display via the incredible emphasis on national security that we saw with John Lee's speech.
Andrew, I mean, it was a wide-ranging speech, wasn't it? 3.5 hours long, almost. I mean, he touched on almost every aspect of life in Hong Kong, from housing to development to the economy, to old people, to young people. Various sectors were told they were going to get funding and boosting: shipping, aviation, technology, the exhibition sector. It really was a very broad-ranging sort of speech. Do you think, though, when you put all those measures together, are they going to be effective in boosting Hong Kong's economic attractiveness?
Well, there are effectively three things here. First, I must admit, I like the fact that he quantified and itemized what he wants to do. And that is the key points. In the first speech he gave back in 22, there were 110 points. And these are actually quantitative points. So he says, I would like 2,500 civil servants to visit mainland China on educational purposes by the end of the year 23. Point. Can you see? In other words, it is quantitative. It doesn't say we will tighten the links between. This is hypothetical, incidentally. Again, just putting it up. So there were 110 points, count them. Now there were 170 points, of which 73 of those were new ones. In other words, I'm not surprised it lasted 3.5 hours, because he increased quite significantly the amount of items, the amount of policy issues that he wanted to bring forward and he wanted to explain. Now, the second point is this is not a budget speech. In other words, he doesn't say, and by increasing expenditure on technology by X%, I expect this to add W% on GDP. That's not really his business. That's not his task. Okay, this is going to be over to Paul Chan in his budget speech, how much all this translates into additional spending in the economy. Some of it was clearly obvious, like the famous baby 20,000, all right? But then, of course, we don't know how many families in Hong Kong just have had a baby and whether this translates into another kind of a voucher scheme. Given the very steep drop in the not only fertility, in births rate, then it's hardly likely that it's going to be a large sum of money. So the second point, this is not about how this is going to support GDP, but where the economy is going to go forward to. And the third point, it is again the very obvious one. It is Greater Bay Area, Greater Bay Area, Greater Bay Area, and Northern Metropolis. This is very, very, very important. In the last year and a half, I've become possibly a resident expert on the GBA, because my clients come up and says, I want to know everything there is to know about GBA in terms of the integration for Hong Kong. And a lot of it is, let's say, good wishes. And now it becomes much harder facts, which I like that, because it is not blah, blah, kind of statements. And looking at the number of quantifiable statements in John Lee's speech makes my life much easier by simply referring to, X thousand things are going to happen by W date.
Okay, well, let's go out of those, 180 points or so. Let's start delving into a couple of them that were sort of grabbed the headlines. I mean, Nick, first of all, the one that was widely expected, a cut in stock trading fees. A lot of people in the financial services industry have been calling for this, and Mr. Lee is obliged. He's going to reverse the emergency increase in the stamp duty on stock trades to try and revive basically what's going on in the financial markets here. He's proposed to reduce the stamp duty on stock transactions to 0.1% from 0.13%. Once that's approved by LegCo. Daily equity trading on the Hong Kong Stock Exchange, it fell 9% in the first 9 months of the year, but IPOs, total equity funds raised, has declined 2/3 in that period. And also it comes after China cut in half its stamp duty on stock trades. So Nick, how effective do you think this is going to be? Is it going to be the game changer that he hopes in terms of revitalising trading on our local bourse?
That's a good question, and honestly, Andrew might be a better place than me to answer it, but I'll share my 2 cents anyway. I think it's not necessarily. I'm not going to criticize it. I think taking moves to reinvigorate the market, as maybe as modest as those headline numbers would suggest, it's a step in the right direction. I think Hong Kong is one of the most, if not the most expensive bourse in the world, and so making anything. Doing anything that would allow that to be cheaper, to encourage people to kind of come back and encourage trading volumes to return, that's going to be, again, a step in the right direction. But I think the second thing that is going to be the big caveat here is a lot of the reason why the markets have performed so badly, and why I think there's been so much financial stress, is because of such weak sentiment, not just in terms of Hong Kong's economy and the direction of Hong Kong's economy, but also what's happening in mainland China. We are still seeing a ton of apprehension in terms of where the mainland economy is going. Yes, we had Q3 data for China's economy showing that there was stabilization in kind of the macroeconomic performance. But first off, I'd caution that there's kind of a tenuous link between economic fundamentals and then what's happening in the markets. But secondly, that hasn't really been enough to sustainably revive investor optimism or just basic investor sentiment around all of that. I think we're going to need to see a broader based indication that things are really improving for sentiment to kind of come back. When we talk to companies here around deal making and everything that would go into the prospects of IPOs, etc., we're hearing that the pipeline has essentially dried up in a lot of industries, given the fact that there are concerns not just in terms of the economic direction, but also the policy direction, the geopolitical direction. There's a lot of things that are going on, which I don't think a cut in trading duties is really going to necessarily have a lot of effect to offset all of this. So again, maybe a move in the right direction, but in terms of yielding any tangible results, particularly in the short term, I'm not sure we can hold our breath. But I'm sure Andrew, you might have some differing views on that.
Yeah, absolutely. Markets go up and down, not because it is expensive or not expensive to trade. They go up and down, as you say, because of expectations and sentiment. And therefore, cutting the stamp duty, I just can't see how this is going to support the market or make it go up. The concept of liquidity and cost always translates in terms of the information available in the market, reflects on the rules and regulations concerning the market, and not how expensive it is. Having said that, however, it is okay, you make it cheaper, and that is not going to attract people to come and invest. It will simply be a relatively minor consideration when it comes to saying, do we buy the stuff in Hong Kong or do we buy the stuff off Hong Kong? A lot of the shares in Hong Kong that are quoted in the United States, people may just decide to come back because now it is relatively cheaper in relationship to what it was, to buy now. So I completely agree with Nick. Prices in the stock market move because of expectations, macro data, interest rates and so on, and not because of taxes on the trading of shares.
Okay, we seem to be unanimous on that. So, Nick, let's talk about the other tax that was reduced. He announced the first change to the housing curbs since they were introduced more than a decade ago. Foreigners will now pay 15% levies on homes instead of 30%, while Hong Kong residents buying a second home will pay 7.5% in taxes, down from 15%. And along with halving those stamp duties, Mr. Lee said sellers will be able to sell properties without tax after holding them for 2 years, down from 3 years previously. That measure, known as the special stamp duty, was first introduced in 2010. And there's also going to be a stamp duty suspension arrangement for incoming talents who buy residential property, but that is subject to them obtaining permanent residency in Hong Kong. And just some data on the housing market. Falling demand and rising borrowing costs have driven existing home prices now down to a 6-year low, and the official housing price index is down almost 8% from a year earlier. New housing also under pressure. There's almost 20,500 vacant properties now in the third quarter, the most in almost 2 decades. So, Nick, is this going to do the trick?
If you had to ask me to kind of sum up, I'd say probably not. Again, I think it's moving policy in the right direction. There's been a lot of pressure from, say, middle-class families and property developers to stabilize a recent pricing slump, and one of the ways you can do that is, trying to cut property stamp duties, as temporary as it might be. But at the same time, we need to remember, several constraining factors. One, interest rates globally are just incredibly high right now, and I think given that the cost of borrowing is still much more expensive than it has been for much of the past decade, that is going to at least have a dampening effect on sentiment. The second thing, which maybe is the larger issue, is that property sentiment, particularly from the mainland, is still very, very weak. And I think, I'm not sure how much of a correlation we can draw between China's property markets and Hong Kong's property markets, aside from the fact that valuations on both just seem to be a bit ridiculous. But I think in terms of sentiment and the willingness to buy, I'm not entirely sure these policy measures are going to revive that either. Again, the housing market does seem to respond to, a degree of speculation, and the fact that particularly mainland buyers look at this as an investment vehicle. And given the developments that we're seeing in China and the negative wealth effects that we're seeing in that market as a result of the property correction there, I think it's going to have a limited spillover into Hong Kong, regardless of the local policy moves. And the final thing I'd say, in terms of what we just mentioned around easing rules for foreign talents to buy and trade property, this is inevitably going to have to be couched in that wider discussion around attracting foreign talent to Hong Kong, as well as the type of talent that has the means to buy prices or very, very pricey flats in Hong Kong. I think, this is going to be targeting a very specific part of the kind of foreign talent pool. And given all of the kind of structural shifts we've seen in Hong Kong in the last couple of years, particularly with more established residents, with families, etc., moving out of the city and not being replaced by new blood, essentially, that raises the question: okay, it's easier for foreigners to buy and sell property, but is this really the group that's going to revitalize the entire sector? Particularly if we continue to see a net outward flow of migration from local Hong Kongers, particularly in the middle class. And so, yeah, I would say, again, maybe cautiously optimistic in the fact that this is, a policy step in at least the right direction in terms of stabilizing the market. But in terms of the actual outcomes, especially in the near term, maybe I'm a little bit more cautious. I'll say that.
Andrew, it seems that this helps developers more than it helps residents, really. I'm sort of wondering why the government wants to stop prices going down, given that we're one of the most expensive cities in the world and a lot of people can't get on the housing ladder.
Yeah. What was very interesting, well, this was interesting to me, is the bifurcation of who got hit in the past and therefore got unhit now. One was foreigners, and at the time when this was introduced, the big bogeyman was mainland Chinese buying out the Hong Kongese of their home and place, home and hearth. In other words, it was primarily directed towards mainland Chinese buying in Hong Kong, the foreigners buying in. And the second part, of course, was people buying more than one flat, in which case, in inverted commas, they were speculating. No, they were not. They were investing, because on the same basis, you should stop people from buying shares, okay, unless they guarantee to you that they are going to hold them for the next 2 years, and they are not buying them because they are speculating. I think there can be a great degree of hypocrisy here. So it was very interesting to see that there were two groups of, let's call them minorities, that they were relieved of some tax pressure. Now, whether this is going to translate as a percentage of the total market, and the market, remember, and that is terribly boring, I apologize, Peter, market consists of two parts, consists of used property and new property. Used property, you simply play musical chairs. This has nothing to do with the developers, it has to do with the individual people in the market, and therefore the impact of that on benefiting the developers will be only if we're talking the new market. And I have always had a lot of trouble differentiating between the two and teasing out which part goes into the existing and which part goes into the new market. So this was a long-winded answer to say that it is likely to be of minority interest, because the two groups that were picked out, it was like saying, I don't know, I'm going to make this completely stupid, like saying Muslim Italians and Roman Catholic Arabs. This was two very small minorities that they were picked out. I'm sorry, I use this because it is a silly way of saying, the foreigners and the speculators.
Okay. Nick, let's talk about the real headline grabber, I think, that came out of the budget, and that's Hong Kong parents with newborns going to receive 20,000 Hong Kong dollars as part of a suite of incentives to boost the birth rate. From basically yesterday, families with newborns will have priority also to select their own government subsidised flats. 10% of the upcoming flats are going to be reserved for them. Taxpayers who live with their firstborn child now or in the future until the child reaches the age of 18, the tax deduction is going to be raised by about 20%. Now, Hong Kong has the lowest fertility rate in the world, 0.8 births per woman, according to the UN Population Fund. And also, Hong Kong has among the longest life expectancy in the world. The proportion of elderly people aged 65 and above is going to increase from 20% of Hong Kong's population to nearly 1/3 by the end of the next decade. So, Nick, what do you make of this measure? Is it the right solution to address the problem?
Well, it's... How do I say this? It's the right solution in the sense that at least the government's thinking about it. But in terms of the numbers that are coming out, I think a lot of people are looking at that, the deductions or even that $20,000 kind of subsidy. And kind of laughing. I think I'll quote Hang Seng Bank here, which I think estimated that in terms of raising a child, average total expenses of 6 million Hong Kong dollars are needed. And so when you think about the tax deductions or that one-off cash incentive, that's a drop in the bucket. And just anecdotally talking to people here around whether this is going to be a decisive factor in family planning, I'm not hearing anything positive. Hong Kong is prohibitively expensive. And I think when we tie it back to some of the other themes we've been discussing this morning around, patriotic education and national security, the sentiment that a lot of people in the middle class particularly have around where the city is going and whether they want to raise children in this environment, that has to be benchmarked against these kind of, family planning inducements. A lot of the overseas emigration that we've seen in the last couple of years has been from the middle class in terms of their anxieties over the type of education that their children are going to receive in the city. And so you already have the people with the financial means who are very, very hesitant around the future of Hong Kong. And for the lower income groups in the city, they're going to require a lot more financial incentives than was currently being proposed in John Lee's speech to think about having a family. And so again, I think I keep saying this because I think it really touches on the points. It's important in the sense that the government recognizes that there's a problem and they're moving in the direction to try and solve it, but the policy just doesn't seem like it's going to be enough.
I started on the basis that children are biodegradable but non-returnable. Okay, that's an essential point to begin with. And the second point was that the policy had a stock effect and a flow effect. The stock effect is these people already were naughty with their wives or husbands. They had the buns in the oven, the babies are born, so they're not going to be stimulated or induced, well, perhaps to go and have another one. Okay, unlikely. So it is on the flow part, which is interesting. And here is where Nick comes and says, before you call your wife and say, switch on the candlelight, put something interesting music, and I'm coming home early from the office, darling. Okay, somebody will have to say yes. That's going to be 6 million honkies. So please come late. Yes. I sent a note to my clients, and one of them was a reminder that years back, the Singaporean government had the same concerns, and they were particularly upset of young graduates not marrying and having children. So they organized cruises to which they invited an equal number of boys and girls, not to go and be naughty, but to know and get to know each other, because apparently this particular group was incredibly difficult to get together and then to foment relations. So it was very interesting. In Singapore, instead of being given 20,000, you are asked to go on a boat cruise with contemporaries of your time. Without, of course, being Singapore, they could not possibly say, and therefore get on with it. Okay, they said simply, get to know each other. Well, I think it was very sweet. It was very nice.
The same impact.
This is also my equal reaction. Yeah, it is very sweet and it's very nice. But if you really want to reverse the aging process of a country, okay, first, this is a generational issue. You're counting on 30 years. So that's not a short-term policy. The fastest one is to encourage specific form of immigration. Very simple. You want a more youthful structure of the population in Hong Kong. Open up the doors, which they're already open, to immigration from China, which also now is having an aging population, but at least it doesn't have as much an aging population as Hong Kong is. And in any case, you have the proportional effect. Only a 0.X% from China need to immigrate in Hong Kong. And this will change completely I'll try that again very slowly, the age structure of the population, the demographic structure of the population. Long-winded answer, it was very sweet, but almost irrelevant.
Okay. Well, finally, let me ask you, Nick, about a topic that was mentioned many times in the speech, the Greater Bay Area. He mentioned it, in fact, 60 times this year. He was talking about Hong Kong investment corporations are looking to creating a fund with the Guangdong government to invest in projects in the Bay Area that deliver both economic and social benefits. The CEO also promised more tourism and business connections with neighbouring Shenzhen to wider exchange and development initiatives. The Hong Kong government's going to also collaborate with the Guangdong provincial government to to develop an electronic services network known as the Digital Bay Area. What do you make all of this? A lot of focus, I suppose, as expected, on the Greater Bay Area, also the northern metropolis as well, just over the border from Shenzhen, got several sort of mentions as well. John Lee's going to publish an action agenda for that shortly, but what did you make of it, Nick?
Yeah, well, I'm going to keep my remarks short just because Andrew's the expert on GBA, so he'll probably have a lot more to say than I will. But I'd say that from our view, looking at projects like Northern Metropolis, we do see that as positive in the sense of encouraging investment spending, which in turn should help stabilize and even lift GDP growth. But the long-term nature of this suggests that these benefits aren't going to materialize until the late 2020s at the earliest. I mean, there's still so much planning that has to be done, so much kind of smoothing of competing local interests. I think the Hong Kong government is also famous sometimes for its bureaucracy. This ensures that while the policy ambition is there, it's likely not going to translate into immediate economic gains, which I think is something which we can take that theme and apply to GBA more generally. I would say as well that there do seem to be some of, I guess, natural synergies between mainland and Hong Kong, particularly from the financial angle in Hong Kong, and then in the mainland, especially, driving that capital into, say, strategic industries. But the issue with GBA has always been the fact that there are different regulatory regimes around information flows, capital flows, people flows. I think one thing that we noticed in the speech in terms of, streamlined and eased visa access would be very positive in terms of helping remove some of those regulatory barriers. But at the end of the day, it's only going to be removing some of those regulatory barriers. One of the biggest impediments to this scheme has been the fact that you have, this lack of harmonization between, Guangdong, Macau, and Hong Kong. Until we start to see more progress there, I think we can remain optimistic about GBA and excited about its potential, but I think we need to remain realistic around the gains that it's going to offer, at least in the near term. But I'll stop there and kind of pitch it over to Andrew, who I know follows this very, very closely.
Well, I like, Peter, you saying that Mr. Lee mentioned GBA more than 60 times, and I always have visions of politicians coming up to the rostrum and says, I'm going to mention GBA a lot in this speech, so I'm going to start straight away by saying GBA 60 times to get it out of the way. Okay, so here I am. I've mentioned it. Okay. GBA can be a nefarious concept, can be something very concrete. It's getting much more concrete. For example, the things that I saw in the speech reflecting back to the action points were much more concrete and numerified, quantified than simply saying we are tightening up relations. One thing, for example, I'm not diverting here, that immediately prickled my ears was that he said, John is now quoting Mr. Lee, I'm going to make it easier for the transference of data between the GBA and Hong Kong. And that has been quite a problem. Because when China itself 2 years ago passed its own data law, it became very difficult for the transference of data between China and anybody, including Hong Kong, which was rather strange because Hong Kong is part of China, but then it isn't. Okay, so I rather like that because the existence of a colossal amount of big data in China is of keen interest to companies and initiatives in Hong Kong. And I would like to see that this is going to be liberalized. But of course, depends very much on the definition of what is politically, let's call it correction, national security sensitive in China and what it is not. But that I liked. I mean, this is you put your finger straight into a point that some of my clients were very keen to hear about. I will be able to get data out of China without having to sign too many pieces of paper, crudely.
Okay, well, look, thank you very much for your insights there. Sadly, we've run out of time. Lots more we could talk about. It was a 3.5-hour speech at the end of the day, but we haven't got 3.5 hours this morning to delve into it. But you heard there Andrew Freris, who is the CEO of Ecognosis Advisory, Nick Marro, who is lead for global trade at the Economist Intelligence Unit. I'm joined now by Vandana, who is founder of Vanda Insights. Good morning, Vanda.
Good morning, Peter. Thank you for having me on your show.
You're very welcome. Well, look, we're back again in volatile oil markets. We seem to be seeing almost every day 2% plus moves in Brent crude oil, as well as all the usual things that we've talked about in the past that affects it, the OPEC production cuts, the economy, the state of stockpiles. We've got a new concern now, haven't we, which is what's going on in the Middle East between Israel and Hamas. That seems to have built in now a war premium, but am I right in assuming that the Middle East issue is now the number one driver behind the oil price at the moment?
Arguably, yes. It is the war premium, as you just mentioned. Look, Israel-Hamas conflict has not impacted oil supply from the Middle East or production for that matter, but it's the fear that should this escalate into a regional conflict and suck in more countries in that region into a military combat, which may in turn then affect their oil production or supply. So as you can see, just from my explanation, there are so many dots to connect. And really the oil market is flying blind here when trying to assess, let alone price in, what exactly is the risk to Middle Eastern supply. So in a situation like this, you will see the market keeping a very close eye on headlines coming out of the Middle East on how this conflict is shaping up. And I think we just need to be braced for ongoing volatility, not just on a day-to-day basis, but even intraday, we are seeing major swings in crude prices.
It seems to react to almost every piece of news, doesn't it? Like Benjamin Netanyahu was saying today that he was preparing to put troops into Gaza, and suddenly the oil price is up 2%.
Yes, I think the oil market participants cannot afford to wait for any eventuality to pan out. You know, that has always been the nature of the oil markets. You want to take positions in an anticipatory basis, protect your positions. So you will always want to jump ahead. But it's also complicated by the fact that a lot of the headlines are just rhetoric. So, you know, when threats or the worst case scenario risk doesn't pan out, then of course, you have to let go, unwind your positions, and then you see, which is why you see sharp spikes and then a drop in prices. And, you know, so as I said, that kind of volatility is just, you can't escape that as long as this situation continues to fester, which from all accounts looks like will be the case.
Have you a sense of how much the war premium is? In other words, where oil will be if it wasn't for what was happening in the Middle East?
Yeah, so as we speak, Thursday morning, Brent is trading just above $90 per barrel. At this level, I would say we easily have at least a $5 per barrel premium in crude.
Okay, so it is substantial, but I suppose the fear, if the conflicts were to spread, is Iran, isn't it? That Iran could end up being involved in this, and there's a lot of saber rattling going on over there. But is that the main worry?
It is the worry in the sense that the rhetoric has been the loudest from Iran. And unfortunately, the oil market does have instances in history where Iran did threaten to block the vital choke point of the Strait of Hormuz, which sees nearly 17 million barrels per day of oil crossing through back and forth between the Persian Gulf and the rest of the world on a daily basis. And the other, of course, is a very well-known fact now that Iran has proxy militias in the region. And it hasn't really been subtle, shall we say, in threatening Israel that it would be fighting on multiple fronts, implying that its proxy militias in Yemen, the Houthi rebels, of course, the Hezbollah in Lebanon, and the Hamas are already engaged in conflict with Israel. So yes, Iran is the single biggest danger. But then again, connecting the dots, when the oil market is trying to assess the risk of a wider conflagration, it's that if Iran jumps in, then chances are that other regional countries, and all of whom are pretty much major oil and gas producers, would have to jump in as well, which then makes the problem much bigger than simply, let's say, Iran holding back its oil or Iran trying to prevent the flow of oil through the Strait of Hormuz.
And if that worst case scenario happens, what happens to the oil price? Where do you think it goes to?
It's it's almost inconceivable. It's never happened. It's never happened in history that all of the Middle East was prevented. Either major oil production was shut in across the region. Nearly a quarter of the world's oil is produced in that Middle East region. It's never happened. So it's very hard to assess what that situation might look like. And arguably, that would also perhaps pull in countries in from the rest of the world, in which case you have World War III. So, it's inconceivable. There will be no limit. Forget about even talking about $100 oil. It could continue spiraling up into triple digits.
And what about the production cuts? Saudi Arabia's had a big impact, hasn't it, in terms of getting these production cuts in place? Presumably, they're also having a big impact on the oil price as well.
Yes, indeed. And that has been a major supportive factor and occasionally a bullish factor in driving prices up, and especially if we're talking of Brent from the 80s into the 90s in recent months. And from the looks of it, OPEC Plus is determined to stay on that path. They are removing currently about 3 million barrels per day of crude from the market compared to, let's say, the start of this year. I think they've also made it pretty clear in the past that they're not going to react in terms of putting more oil into the market to what they see as temporary spikes or spikes in crude that are caused by what they deem speculation, the current case being an example, a fear premium, a speculative premium. So OPEC Plus is very much in control of the market. From the looks of it, they are going to continue that stance well into 2024 as well.
So it sounds like then they're not going to be dissuaded by what's going on in the Middle East at the moment to reassess.
No, certainly not. And the irony of the situation, unfortunately, which what makes the worst case scenario really bad, is that the spare capacity to make up for any drop in any disruption in supply is all in the Middle East, which is the region which would be at risk. So, which is why I said it would be Armageddon if God forbid, more countries in the Middle East get drawn into a military combat.
And what about stockpiles? The US has been dipping into its stockpiles, hasn't it? What sort of influence is that having on the oil price?
So one of the biggest visible effects of these OPEC Plus cuts, now going on for nearly 6 months, has been a drop in commercial crude and refined product inventories across the world. And of course, most prominently visible in the OECD countries, where they're measured and reported on a monthly basis, and even more so in the US, where they're reported on a weekly basis. So we have seen crude respond quite sharply to the report that comes out every Wednesday from the US, talking about US crude and product inventories, of which for the past several weeks have shown sharp declines. So that is a reflection of the OPEC Plus cuts taking away supply, prompting major consumer nations to dip into their inventories. So that has become a major worry factor on the supply front, a major factor for bullishness in crude prices as well, especially going into the Northern Hemisphere winter months. You want to have a comfortable cushion of inventories to dip into, also in the event of supply disruptions, and not just in the Middle East, but that is the story of the oil markets. You can get hit by a major supply disruption without much notice. But that is OPEC Plus's stated aim. They are trying to reduce the supply inventories. Clearly they want prices to remain in the sort of $80 to $90 band for crude, which is again expected to be their aim into 2024 as well.
I remember it wasn't that long ago that the US was talking about being totally self-dependent when it comes to oil. It didn't have to rely on OPEC or the Middle East because it had all this shale oil. What's happened to all of that?
Yeah, so that time has long gone. The US is no longer what we call in the oil market a swing producer, which is being able to quickly respond and put major volumes into the market if prices are going up. And we know when we talk about global crude prices going up, the biggest pain point, of course, in the US is prices at the pump. And they have this sort of a red line at $4 per gallon mark, which tends to, and especially going into the election year, right, which tends to sort of infuriate and annoy people quite a lot. So, but the US has lost that ability. The shale sector, which pumps more than 3/4 of total US oil, now is in a completely different era. It is sticking to capital discipline. It is returning money, profits, humongous profits from last year back to the shareholders, paying off debt, and now consolidating. We've seen with the ExxonMobil Pioneer deals and the Chevron and Hess deals. So the U.S. production is continuing to recover from a big steep drop in 2020 and 2021. But very steadily. It's not going to respond to high prices caused by OPEC plus cuts, which is why, as I said earlier, OPEC plus is really in control of the markets right now.
And what effect is the economy overall having on oil prices? We're getting a very mixed picture, aren't we? The US seems to be doing better than what people thought economically. The Eurozone seems to be doing worse. China also is disappointing. So lots of mixed signals on the economy, but what's the impact of all that on the oil price?
So I expect once the dust settles on the Hamas-Israel front, we will see crude go back to tracking the two main factors, namely OPEC plus cuts, which is pretty much, we know what to expect unless they spring some surprises, and the economy. So economic sentiment, and quite rightly, as you just noted, it is tends to focus on what's happening in the US, in the Eurozone, and China. Economic sentiment is basically serves as a proxy for oil demand because, by the time any changes, big swings in economic activity percolate down to oil demand, it's quite late for the oil markets. Again, as I said, you want to react in advance. So it is used as a proxy. So yes, it is a very mixed picture, which makes it harder for the oil market to assess, what it should be prepared for in terms of 2024 oil demand, especially oil demand growth. As of now, the expectations are that the U.S. economy will evade recession. But Europe, of course, is in a bad shape. I think that was reinforced by the PMI data that we saw this week. And as far as China is concerned, the way I see it is it's the economy is chugging along. Yes, there was a major stimulus announcement again this week, but nobody has moved the needle on their expectations for Chinese oil demand growth as a result of that stimulus. It remains to be seen what impact, if any, it has on the economy. So, those are all the considerations for the oil market. But right now, they are being way overshadowed by what's going on in the Middle East. They'll come back to center stage once the conflict in the Middle East subsides.
Vanda, always a pleasure talking with you. Thank you very much indeed.
Thank you, Peter.
That's Vandana, who is founder of Vanda Insights.
You're listening to Peter Lewis's Money Talk. Money Talk.
Thank you for listening this morning to Money Talk. Do please take a look at my newsletter at peterlewismoneytalk.substack.com for more information on developments during the Asian trading day. I'll be back tomorrow with another episode of Money Talk. I'll be joined by Francis Lund, the CEO of Geo Securities, and John Schofield, Managing Director of Tempest Investments. And with a view from Australia is Toby Lawson, the CEO at Staten Partners. Please join me again tomorrow.
Money Talk